In August 2000, Enron Corporation stock traded at 90.75 per share. It was the seventh largest company in the United States. Fortune magazine had named it America's most innovative company 6 years in a row. Its trading floor handled more energy contracts than any institution in the world. And then, 16 months later, its stock was worth 26 cents. Enron had not always been a trading company. It began as a gas pipeline operator, a relatively boring business that moved natural gas from one place to another. Then, in the 1990s, its leadership decided that the future was not in owning pipelines, but in trading energy contracts. The idea was simple, in theory. Enron would become the middleman for every energy transaction in America. And for a decade, the numbers suggested it was working. What made Enron different was the culture it built around itself. It hired from the top business schools. It paid its analysts more than Wall Street banks. It told its employees, and believed, that it was the smartest company in America. When analysts questioned its business model, Enron's executives dismissed them as people who simply did not understand how the new economy worked. And for years, that dismissal was accepted. In late 2000, a hedge fund manager named Jim Chanos began to study Enron's financial statements carefully. What he found was that, despite enormous revenues, Enron's actual return on investment was remarkably low. More troubling, the financial statements were almost impossible to understand. He began to bet against the stock. Almost nobody listened to him. In early 2001, a Fortune journalist named Bethany McLean wrote a single article with a simple question. How exactly does Enron make its money? She had read every public document the company had filed. She could not find a clear answer. Enron's CFO flew to New York to meet with her and explain the business model in person. After the meeting, she still could not explain how the company made money. She published the question. Enron's stock barely moved. By the summer of 2001, something was changing. The stock had begun to fall. Slowly at first, from $90 in August 2000 to $60 by February 2001. Then faster. In August 2001, Enron CEO Jeff Skilling resigned after only 6 months in the job, citing personal reasons. He was the fourth most admired executive in America. CEOs of healthy companies do not resign after 6 months. When Enron signed a contract to supply energy over 20 years, it needed to decide how to account for that contract. Normal accounting is straightforward. You record the revenue when the money actually arrives. Enron used a different method, approved by the U.S. Securities and Exchange Commission in 1992, called mark-to-market accounting. Under this method, Enron could estimate the total profit of a 20-year contract and book that entire estimated profit on the day the contract was signed, not when the money came in. On day one. The problem was the estimate. If Enron decided that a gas contract was worth $1 billion over 20 years, it booked $1 billion of profit today. If the contract later turned out to be worth less, or worth nothing, Enron would need to write down the loss. But by then, the executives had already been paid their bonuses based on the original estimate. The incentive was simple. Make your estimates as large as possible. Book the profit now, and deal with the reality later. The second mechanism was more deliberate. Enron's CFO, Andrew Fastow, created a series of separate companies called special purpose entities that existed outside Enron's official balance sheet. When Enron had a failing investment, it could transfer that investment to one of these separate entities, removing the loss from Enron's accounts entirely. The entities were secretly funded by Enron itself. What looked like an independent company absorbing a loss was actually Enron hiding its own failure from its own shareholders. Arthur Andersen, one of the 5 largest accounting firms in the world, was Enron's auditor. Its job was to verify that Enron's financial statements were accurate. Andersen signed off on Enron's accounts every year. The credit rating agencies, Moody's and Standard & Poor's, maintained investment-grade ratings on Enron's debt until 4 days before the bankruptcy. Every professional institution whose job was to find the problem did not find it, or chose not to look. In October 2001, the Securities and Exchange Commission opened an investigation into Enron's finances. Within weeks, Enron was forced to restate its earnings for the previous 4 years, reducing reported profits by nearly $600 million. Investor confidence collapsed. The stock fell from $20 to 26 cents in 6 weeks. On December 2, 2001, Enron filed for bankruptcy. It was the largest corporate bankruptcy in U.S. history at the time. 4,000 people lost their jobs that day. The collapse destroyed more than Enron. Arthur Andersen, the firm that had signed off on Enron's accounts, was found guilty of destroying documents relevant to the investigation. The ruling was later overturned on appeal. But by then, the firm had already collapsed. 28,000 people who had nothing to do with Enron lost their jobs at Arthur Andersen because of what Enron's auditors had done. Jeff Skilling, Enron's CEO, was sentenced to 24 years in prison. Andrew Fastow received 6 years. Kenneth Lay, the chairman and founder, was convicted and died of a heart attack before sentencing. Enron did not collapse because the energy business failed. It collapsed because its financial statements described a company that did not exist. Every reported profit was based on estimates of future income that had not arrived. Every hidden loss was in a company that existed to make the loss disappear. The auditors confirmed it. The rating agencies confirmed it. The system designed to find this kind of problem functioned perfectly, as long as nobody actually used it. The people who built this system are in prison. The firm that audited it no longer exists. The regulations it exposed were eventually changed. But the question nobody has fully answered is, which of the three failures was the most important? The executives who built a fiction, the auditors who certified it, or the regulators and rating agencies who never questioned it? Because each of those three failures was also a choice.